QE isn't free money. It's a swap that changes what the entire system holds, and that shift hits yields, mortgages, stocks, and rent. If you think QE is a cash giveaway, you'll miss the real story. Who feels it first? Why the inflation debate never dies? And what happens when QE goes in reverse? I'm going to explain QE with one balance sheet, so you see the plumbing, not the slogans. Let's do this with one picture. No jargon Olympics. There are two characters, the central bank and the commercial banking system. Before QE, banks and investors hold a lot of bonds. Banks also hold reserves. Think of reserves as checking accounts banks have at the central bank. Households don't have these accounts. Banks do. Here's QE in one sentence. The central bank buys bonds and pays by creating new reserves. And here's the line people miss. Reserves aren't your money. You can't withdraw reserves at an ATM. You can't send reserves to your landlord. Reserves live inside the banking system. They're used for settlement between banks. So QE doesn't automatically hand households cash. It changes the mix. Less bonds, more reserves, more liquidity in the pipes. If QE were free money, your phone would buzz. Congrats, you've been QE'd. That notification does not exist. So if QE isn't a cash giveaway, what is it trying to do? QE is designed to push down long-term yields, especially when short-term rates are already low. The central bank buys a lot of bonds, which removes a big chunk of duration from the market. Now imagine you're an investor. You sold a bond. You're sitting on something more liquid now. You don't want to earn nothing forever, so you rebalance. Corporate bonds, equities, real estate, private credit. That's the portfolio balance effect. This is why asset prices can rise fast under QE, not because QE magically makes everyone richer overnight, but because it changes the price of safety and the price of risk. And the real economy feels QE later, through second-order channels. Easier financial conditions, refinancing waves, tighter or looser credit spreads, business borrowing costs, and confidence about hiring. A clean mental model. QE changes the road conditions, not your destination. It makes some paths cheaper, some risks easier to take, and behavior shifts. Now the spicy part without turning this into politics. Who benefits first? Usually people who already own financial assets, and people who can borrow on good terms. That's not ideology. That's transmission. If you own stocks or real estate, rising prices show up quickly. If you don't, you experience it differently. My costs are up, and my wage didn't move. That timing gap is where frustration comes from. Also, quick myth cleanup. Banks don't lend because they have QE cash. Lending is constrained by capital, risk, and loan demand, not simply by how many reserves exist. Reserves help settlement and stability. They don't automatically turn into new loans. So QE can reduce the risk of a financial seizure, which helps everyone, but it can also widen the feeling that gains show up first in asset markets while paychecks lag. The mature conclusion isn't QE is evil or QE is fake. It's this. QE stabilizes one part of the system and can distort incentives in another. Does QE cause inflation? Honest answer. It can, but not as a simple QE equals CPI equation. One side says QE is printing. They're reacting to asset inflation and risk-taking. The other side says QE isn't money. They're correct that reserves aren't household spending power by default. Both touch something real, just in different parts of the system. The clean way to think about it, QE changes financial conditions. Inflation shows up when spending outruns, supply when demand exceeds productive capacity, and when expectations start to shift. That's why you can have long periods of QE with calm CPI, and then inflation suddenly arrives when forces stack. Supply constraints, fiscal expansion, strong demand, energy shocks, shifting expectations. If you want one sentence that's true, QE can be inflationary when it successfully boosts demand into a constrained supply environment. Not always, not never. Conditions matter. QE doesn't live alone. Eventually comes the unwind. QT. QT is the reverse swap. The central bank shrinks its balance sheet. Bonds roll off or get sold, and reserves decline. The market has to absorb more bonds, which can push yields up. Higher yields feed into the stuff you actually feel. Mortgage rates, borrowing costs, and valuations, especially for long-duration assets. When the low-gravity environment goes away, the floating stuff drops first. QT doesn't mean money is deleted, like a movie plot. It means the system is running with less cushion, less excess liquidity, so shocks can feel sharper. QE is like adding lanes to a highway. QT is closing lanes for construction, then acting surprised when traffic gets aggressive. Now lock this in. QE is not free money. It's an asset swap. Bonds move onto the central bank's balance sheet. Reserves rise inside the banking system. QE mainly works by pushing down long-term yields and nudging portfolios out on the risk curve. That's why assets can move first. Inflation isn't automatic. QE changes conditions. Inflation depends on demand, supply, and expectations. QT is the unwind. Less liquidity, more bond absorption, tighter conditions, higher yields, and you feel it through mortgages, borrowing costs, and valuations. So the next time you hear QE printed money, translate it into something real. The central bank swapped bonds for reserves, loosened conditions, and changed the pricing of risk. That's the mechanism. That's the consequence. If this made QE finally click, like and subscribe for more system mechanics explanations without the drama. And if you want the perfect follow-up, watch my video on treasury yields, because once you understand yields, you understand why QE and QT ripple into everything from mortgages to markets.